Welcome back to the exchange. Assets in U.S. sustainable funds are nearing $200 billion as of the end of the third quarter. They've more than doubled in less than 3 years. And with the Biden administration expected to put a spotlight on ESG investing, the trend looks set to accelerate even more. What does it mean for investors? For more, I'm joined by Henry Fernandez. He's the chairman and CEO of MSCI. Henry, it's great to have you here. What do you expect under a Biden administration?
It will be a huge spotlight on sustainable finance and investments, much more than during the current administration. To begin with, I believe that the Biden administration will join the Paris Agreement, and therefore, from the federal government perspective, there will be a lot of leadership in terms of combating climate change. That's going to percolate throughout, every part of society in America, including corporations and other issuers. So that's one big change. The second one is that the Biden administration will obviously focus a great deal on the pandemic and the impact on the health and well-being of people in the country, and especially the employees of companies. And therefore, companies are going to have to be very focused, continue to be focused on that. So that will be another spotlight. A third one, and a very one, is social issues like racial injustice and the like. So the Biden administration is going to be all over this, and that's going to have an impact on the response of companies.
One of the concerns people have is that ESG funds, can attract a big following without people knowing exactly what they're signing up for, and that companies themselves are adapting to try to be ESG friendly no matter kind of what industry they're in, including some surprising candidates. Here's what Burton Malkiel told our Bob Bassani about that a few weeks ago. Henry, take a listen.
My concern is I don't know what's a good company and what's a bad company, and neither does anybody else. Is the utility that burns coal a bad company because it burns coal? Or is it a good company because it's doing an enormous amount of investing in wind power? I don't know that any ESG broad-based fund is really one that makes me feel confident that I'm investing in really good companies.
Henry, what would you say? I mean, he's one of the great investing minds alive today.
He is, and I have a great deal of respect for him, and I took him as a student of economics at Princeton. But I would beg to disagree. A lot of what we do, for example, is to try to understand what are the material factors in ESG considerations that will affect the performance of a company. So, for example, if you have a company that has a very hostile working environment, discriminating against women and other minorities and the like, that is not a company that is going to attract a lot of customers, a lot of employees, and they won't be able to hide because that information is now much more relevant around the world. So will that be incorporated immediately into the stock price of that company and the cost of capital? Maybe it will take time, but over time, for sure, it's going to affect its business. Similarly, if you're polluting the environment, similarly, if you have bad governance and the like. So I think that a lot of these issues, particularly the material ones that affect the performance of a company, need to be taken into account into any investment portfolio.
Well, and to your point, I mean, you guys do kind of these rankings what we're used to seeing on the credit side so that perhaps you can incorporate some of that information. I have to leave it there, Henry. I appreciate you joining me today. There's a lot more to unpack. I know we want to talk some China as well. If you'll come back, we'd greatly appreciate it.
Thank you for having me.
Shepard Smith here. Thanks for watching CNBC on YouTube.